All right, guys, joining us now, we've got Rebecca Walser, who's the president of Walser Wealth Management, joining us on the day to help break down today's activities. Great to have you here, Rebecca. Let's break things down first on stimulus. We have new stimulus. It will come with higher closes across the major indexes, as we've seen on today's activity. What are your biggest takeaways from today's session?
Wall Street loves stimulus right now, Brad. So whenever we're not fully reopened and back to normal, which whatever that will eventually be, we'll see. But I think that just the markets, just react with just, it's not irrational exuberance, but just as a natural, healthy exuberance that, okay, we're not going to be left completely to our own devices to reopen organically. We still have, the government trying to fill the holes from, being shut down with the virus.
We spoke to a guest earlier this week who had suggested that this is already priced in, this stimulus package, with essentially the activity in January in those Senate runoffs clearing the way, as many had suspected, for this to actually pass through Congress. And so now that we actually have signage, the market's continuing to move higher. What could that signal about how far out the markets are looking right now, and where this type of relief, as we should say, this relief package and the dollars that come along with it, whether they be for individual households or small businesses or even some larger enterprises, how that will be put to work for employment and where that will re-enter into the economy?
Yes, all great exact points, Brad. And I will just take that one section at a time. So let's just look. Even though the market already had priced it in, we did get additional actual stimulus checks in this bill. So now you've got people that are going to get $1,400, married couples under 150, singles or head of households 75,000 or less. So that's the threshold. It phases out beyond that after just a bit. So that is actually going to help, because we did see in January, when we had those $600 stimulus checks, that personal spending did pick up 2.4% in January. So now we've got almost a tripling of that check going out. And this time, Brad, it's going to go to even disabled adults. So if you have a dependent that is an adult, they also will now also get that $1,400. They did not get that the first couple of rounds. So we do expect personal spending to be affected, and that's positive. We also are, Brad, seeing additional businesses reopen, which obviously is giving us good employment numbers, which we've seen last month and this past couple of weeks. And so overall, in general, we're seeing a trajectory of, some health and some great retail numbers, employment numbers, personal spending numbers. But unless and until we get the actual businesses reopened to sustain it, we're going to constantly be in this perpetual cycle of, okay, we've got enough for the next couple of months, but then what, then what, then what? And so that's really where we have to really digest what is this administration's plan to get this economy going again organically.
We got new record highs at the close, the Dow, the S&P 500, and the Russell 2000. We know that there's been some choppiness in the NASDAQ. However, this week we have seen some huge days for the NASDAQ as well, back to the upside. How much room left to expand do you believe there is for some of the equities market activity and the records that we've already seen over the course of 2021 thus far?
It's an interesting dichotomy, because what you're seeing is a lot of, like, for example, tech really saved us last year, right? But now look at the PEs in tech. And how long can we consistently have upward trajectory? And with stimulus, the money has nowhere to go, Brad. People aren't buying bonds. I mean, some people are with the yields going up in the last 2 weeks. But for the most part, to get yield, get return, you're going to go into equities. And so how long can we keep having the inflationary pressure on equities continue if we aren't actually seeing, the actual sales depth and breadth that we need to maintain those PE ratios? That's what my concern is I think that the stimulus is totally necessary and has definitely given us a buoy from, going into a depressionary cycle. But at the same time, it must be followed through on to get back to open. And so that won't be as great for the tech giants that we've really relied on these last, 12 months to really get the market up. And so we need to see more breadth and more depth. And I definitely want to see travel, business conventions, luxury, and all kinds of cruises. All of these sectors are still not back to normal, Brad.
So I guess the pressure now continues to be on watching some of the yields. The 10-year was notably in focus at the beginning of this year. Do you believe some of those concerns have dissipated, or are they still very much in focus or in the back of minds of investors?
They're very much in focus for me. I'm thinking, you know what, this inflationary pressure, you just got to look at the PE ratios. I know we're going to talk about Ulta. Hopefully we'll get their earnings. But, the PE ratios, DocuSign, 196 PE ratio. I mean, these things are just outrageous and are not sustainable unless we really get some of the economy back to some level of normalcy. So, I think we can stimulate for a short period of time longer, but we definitely have to worry about inflation. And I almost feel sorry for Chairman Powell, because he is trying to deal this really delicate balance between stimulating so that we don't, have problems, but not hyper stimulating where we have inflationary pressure, because we are reopening and we do have some good economic indicators on, businesses going back. So it's this really delicate balance, and we will get inflationary pressure, Brad, as we've already seen these last 2 weeks, if it's not the right strike of balance.
Absolutely. And, just quickly as well, while we're discussing this and before we get to some earnings that are coming out this afternoon, where do you believe that Fed Chair Powell and Treasury Secretary Yellen now will continue to have their advanced conversations, as there's still very much a policy that needs to be enacted, and you've got two people who have both held the same position before, and now they need to continue to steer this broader kind of response effort throughout these next couple of months and really a couple of years with regard to some of the rate policy that still needs to be kind of in line with exactly how the economy is accelerating in its recovery, even though it is moderating right now, as Fed Chair Jerome Powell would say.
Absolutely. It's a great point, Brad. And obviously right now we're in a blackout period until the next FOMC meeting, March 16th and 17th next week. And, it's been interesting because we really were getting last week with Powell's speech last week. I was quite concerned that we didn't quite understand that things were heating up too fast. The steepest yield curves we've seen in a while. And last year we had the potential of going into negative, yields. And so we're seeing a really shift, and that really is coming from, too much stimulus too fast, when the actual organic growth isn't there to support it. And so all it does is create price pressure in equities where the dollars are going to float to. And this is a conversation I do worry slightly about Yellen and Powell, who both seem to sort of discount the inflationary pressure that we've seen in the last 2 weeks. And I don't think that they're giving that enough credence into building their forecast, their modeling. They need to understand that you can't spend $8 trillion in 18 months and not see some kind of problem.
Rebecca, you summoned some earnings after hours here, so I'm going to toss things on over to Kristen Troller, who's standing by with the latest on